Is supermicrocomputer still cheap despite being up over 700% since last year? Crazy question, right? But as you will see, when we'll compare it to companies like Dell, HP, AMD, Nvidia, of course with AMD, Nvidia and Intel, it's not exactly apples to apples, but just so you get a fuller picture and you'll understand my conclusion towards the end, I included them in this video. Now, what does supermicrocomputer actually do? A supermicrocomputer designs and manufactures high-performance server and storage solutions. They are especially known for their motherboards, chassis, and server management software. You might say, what's so special about that? What's their moat? Well, first of all, the fact that they partner up with the likes of Nvidia, AMD, and Intel tells you already a lot. So they got the brand reputation, deep technological expertise, high customization and vertical integration, focus on energy efficiency, and of course, if you want to start and compete with them right now, it's virtually impossible. I mean, to start from the ground up and compete with such a company, good luck with that. Now, if we compare it here to the likes of Nvidia and AMD, I'll start with those two, you can clearly see that even today, at a $44-45 billion market cap, up 737% since last year and up 182% year to date, it is still looking cheaper than Nvidia and AMD when you look at forward PE, price to sales, and price to free cash flow. Now, there might be a reason for that, because if we look at the growth estimates for the coming fiscal years for SMCI, Nvidia, and AMD, although all three are expected, this is again analyst estimates, expected, things can change. Those numbers can increase, can decrease as well. But as you can see, for fiscal year 24 and 25, all three of those companies are expected to grow quite fast. Nvidia the fastest, SMCI second, and then AMD third. But then we'll look what happens in fiscal year 2026. Right now, the expectations are that Nvidia and AMD will continue to accelerate and grow above 20, even sometimes 30%, whereas supermicrocomputers is expected actually to have a decrease in sales by fiscal year 2026 and only grow EPS by 5.78%. So this might also be one of the reasons why, valuation-wise, it is still cheaper than those two. Again, those two aren't really direct competitors. Actually, they're more like partners than anything else. Now, another reason could be, and is probably that as well, gross margin. The likes of AMD, Nvidia above 50, 60, even 70% gross margins. If we look at SMCI's last quarter, Q2 non-GAAP gross margin was 15.5%, which was down quarter over quarter from 17%, as we continued to focus on winning strategic new designs and gaining market share, meaning they are pretty competitive when it comes to price. Of course, you might also say maybe the market thinks that, well, demand will not continue to be this strong, and so we might be nearing the top of the cycle, and that's why it is still a bit cheaper than the others. Could very well be. They said here during the earnings call that demand is still stronger than supply, so if they have more supply, they could be able to ship more and are very happy to continue and grow their capacity, work out betas, even higher support, so they grow the business even quicker. The backlog is growing as well, so they do expect that's also why they raised guidance for this year by close to 40% or so. So they're pretty confident that they can continue to grow and actually see an acceleration in the coming quarters. And if you needed a quick reminder of how the Q2 quarter actually looked, this is why the stock has been going up quite a lot. It's not just a year over year excellent growth here of 103%. It's also quarter over quarter, up 73%. We've seen these types of numbers, these types of growth numbers from Nvidia last year, right? When suddenly quarter over quarter, they're suddenly growing 80% or so. And so we've seen the same here with supermicrocomputer. And as you can see, the majority of those wins here come from companies like Nvidia, AMD, and Intel. So again, I put the comparison there, but they're not really competitors. They're more like partners. And this is also one of their main advantages, right? The rapid adoption of new technologies. They can quickly leverage the latest CPUs, GPUs, and other components from partners like AMD and Nvidia and Intel, often being first to market with new servers and configurations. Obviously, highly customizable systems as well, and they focus on performance and efficiency, which is also why you can see, I mean, yes, net sales increased quite a lot year over year, but cost of sales has done the same. Operating expenses is increasing as well quite a lot. So they do need to invest quite a lot to keep up with that demand. So that was part one. Yes, SMCI right now, the stock valuation wise is cheaper than the likes of AMD and Nvidia, but there are reasons for that. And even if you remove the comparisons, SMCI on its own right now with the growth rates that we're getting, 30 times forward PE is not really the craziest number out there. We've seen higher numbers from many other companies out there that aren't even growing as fast as SMCI. So another thing to consider. Now, before moving into part two, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, moving on to part two, comparing it to the likes of Dell and HP, here are the numbers. So here you can see the big difference. Here you can see that SMCI is way more expensive than the other two. But there might also be a valid reason for that. Because if we look at the analyst estimates for the coming fiscal years and comparing it with each other, you can clearly see that, well, SMCI gets a premium because it is expected to grow much faster than the other two. That said, if we look at HP Enterprise's gross margin last quarter, it was 35.1% on a GAAP basis and actually up 170 basis points year over year. So when you look at gross margin, you can say, oh, but HP has much higher gross margin than SMCI. And actually the same can be said with regards to Dell, a bit lower than HP, but higher than SMCI at around 23-24%. So maybe there is a bit more value to be found with these two companies. Even though they are growing slower, their gross margins are quite higher. Something to think about. Now, the other thing I want to show you is shares outstanding, free cash flow per share, comparing each and every one of those companies. As you can see with Dell, by the way, also quite a great performance. Stock is up 102% year over year, $60 billion in market cap approximately, and a forward PE of 12.5 times. And as you can see over the last couple of quarters, actually, shares outstanding have been coming down. And even since 2021, shares outstanding have been coming down quite rapidly. Free cash flow per share over the years have come up. And then here in fiscal 2023, the company has taken a hit, but we do still need to get an extra report that will be at the end of February. If we look at HPE, market cap of $19.41 billion, a forward PE of 7.7 times. The stock's performance has not been great there, down 6.46% year over year. Yes, over the year, shares outstanding have been coming down as well. And free cash flow per share, the last 2-3 years have been a bit flat-ish. We're also getting a earnings report at the end of February, so expect that bar here to be a bit higher. And then the last one, SMCI, here shares outstanding have actually been increasing because SBC is also quite higher year over year. But of course, with the huge growth that the company has experienced, free cash flow per share has basically exploded. And even the EPS estimates are quite high right now, especially compared to the other two that we've just looked at. And so lastly, looking at the graph after months and months and months, even a year of continuously going up and up and up, it does seem that right now we might have reached a top. And well, the market has just found more sellers than buyers. If you're looking for, let's say, support areas, the 20-day moving average sits at $664, the 51 at around $500, and the 200-day moving average at around $318. Yes, on the daily, we are not overbought anymore, but we are still quite high with regards to RSI. If we look at the weekly, actually, the weekly, of course, last week, as you can see, there were just way more sellers at the end, but we are still way overbought. Way overbought, has been like this for, well, quite a while, since the start, mid-January, I would say. So let's see what happens. Let's see what happens next week, if the pressure continues or if suddenly there are still more buyers somewhere at certain prices. Of course, with Nvidia's earnings report, that might make or break the AI chip, let's say, sentiment. Do let me know down in the comments below what do you think. Do you think at these prices, these valuations, comparing it to all the companies that we've compared it to, do you think it still makes sense, or do you think it's just pure hype and just you wouldn't touch it? Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.